Earnings season is here with many popular and especially tech names reporting next week, like Apple, Amazon, Meta, but also a lot of companies from various sectors. And so if you trade options around earnings or interested in earnings season in general, stay tuned, as in this video we will do a deeper dive into what's behind the current volatility levels of names like Amazon. We will focus on Microsoft also, as perhaps some trading opportunities will arise there. So stay tuned and let's jump in. Alright, so welcome to this weekly video where we do an overview of upcoming earnings and dive into interesting names and what types of plays we can make. As always, we start with the calendar by implied move that you see right here. And as we mentioned, earnings season is starting with very famous names, as you can see, tech names, but also various other sectors. And so we see this wide range of moves going from 3% to 10%, so pretty much a lot of volatile, but not so volatile names as well. We directly spot here Sophie and UNH, CVS, that seems to be of the highest implied next week. And the most popular names, the tech names that are sort of spread out. We see here Apple at around 4.5%, Amazon around 6%, Meta of the same. And so these numbers, as you know, give us an idea of the market expectation. Reminder, the implied move that you see here on the left axis is the amount of move, absolute move, so up or down, that is priced in by the options market. And this is calculated from the closest expiration straddle, so a call and a put at the money. Now, as you know, we need to put that number, those implied moves number, in context, and so basically see how they compare intuitively to what happened in the past. So the historic, basically, volatility levels. This is what we usually see in our past average versus implied move graph that you see right here, where basically now we compare this implied to the average historic move. And so, as you would expect, the diagonal line is pretty much where the pricing is sort of spot on the implied move. The current volatility level, what we call implied volatility, is matching the historic volatility. However, we notice also some sort of discrepancies or outliers. And so, for example, notice how tech names like Amazon, Microsoft, and Apple seems to be on the undervalued side. So this bottom side where the implied move is somewhat lower than the average move. So these are interesting opportunities to investigate basically what's behind and how we can play it and profit from that. On the other side, as we mentioned, other names seem to show an overvaluing aspect where, for example, for CVS and UNH, seems that the implied move is sort of inflated, is higher than the average move. So you see here a 9% for UNH versus a 5% only on average move. So these constitute good candidates to start investigating, and so let's actually do that and dive more into some of these names. Let's start with a very expected name, Amazon. So that's reporting on Thursday after close. And so let's go ahead and analyze a bit more this current implied, compare it to what's happened, and see basically, try to understand the mechanics behind it. And so here we open the moves analyzer when we can investigate a bit more of these past moves and volatility. And so we look at this first table showing the breakdown of what happened in the past. And so right away we see an interesting phenomenon where Amazon seems to have been calm in the last three earnings, just after a big move, the very high move of 12% on August last year. And since that, there has been sort of calm or steady levels where the moves were lower than the implied moves, as you can see here, 7% versus 8, 4 versus 7. And so we notice right away this trend where the actual current implied move that we were looking at, which is here exactly we see of 5.8%. The interesting thing is that it's actually lower than what was the past, so the average move, but also the last implied move. There is sort of a declining trend where this implied move is getting lower and lower. And this is somewhat understandable because, as we can see, basically the market tried to price in or to adapt to this big move that happened last year. We're talking about this 12% move. And earnings after earnings, since there was not a big move that was actually happening, the markets is sort of seeing down its expectations, and so now we arrive at the lowest of the last year. However, as you know, when we try to find these long volatility opportunities, so a realized volatility that will beat the implied volatility, we want the numbers to be on our favor. And so one classic metric, one simple metric we look at is what we're seeing here, where basically, let's see, on all past releases, when the actual move did beat the implied move, what was the average value then? And vice versa, when it did not beat the implied, so this would be the losing case for long volatility, buying straddles and strangles, etc. Well, what was the average of the miss? And basically, as you understand, we want an average of beat that would be higher, much higher than the average move or the average miss when there was not a beat. The idea is simple, that we want basically a big mover or earning a big beater, so that our good case scenario has a high upside. However, if there is a small move and it ends up being in the bad scenario, our loss will be sort of small or minimal, because that amplitude, that average amplitude of missing is very low. When we look at these numbers for Amazon, we're not quite convinced, because as you can see, both amplitudes are sort of close to each other, 1.3, 1.8. So, and this is confirmed visually when you look at the comparison between the implied and the actual. The difference is not that high, and it seems to be symmetrical. So this is what we mean by perhaps not ideal for long volatility. But again, the market seems to be perhaps not expecting a big move. And so that's the type of setup where if there's a big move, potentially the reward can be quite high. As we mentioned, the implied move is in a declining pattern, and so the current implied move of 5.2 is basically the lowest that has been since a year and a half. So that itself is a good signal. Now let's continue our analysis and see how these numbers stack up for other names. And so we saw that Microsoft was also somehow in the same area where it seems to be undervalued. So let's understand a bit more what's behind it. And here right away, we see the difference with Amazon, where contrary to Amazon, Microsoft has not been calm in the last earnings. Actually, quite the opposite, where there was a very calm period, mostly in 2024. But then, since the October release of 2024, we have seen some good moves that at least have been beating the implied move. As you can see, the last one of 10% versus 7, 6% versus 4. And the interesting part here is that contrary to Amazon, even if the moves have been constantly, at least in the last year, beating the implied move, well, the market is not seeming to really price in this move, as we've seen that the current implied move of 4.2% is actually, as we see here, quite lower, not only that of the past average move that we noticed, but also even lower than the last implied move. So as we come back to the table, you see that the last implied move was somewhere around 7.6, closer to 8. And so it was expecting a big move, and actually you see that it was basically the double of the previous implied move. The market, the actual stock, did deliver, and so the move was quite high. You would expect that the market will upper its expectations to match these high levels of volatility. But it seems that for Microsoft, it's not necessarily the case. And so this makes it quite interesting as a long volatility candidate, because it's of this underpriced or undervalued volatility. And then as we scroll down to those average numbers of beats and misses that we discussed, here we see right away a set of numbers that is more favorable, where even though the difference is not huge, but still the amplitude when the actual move does indeed beat the implied is actually higher than the amplitude when it misses. So we see here a 2% versus 1.4%. Not a huge difference if you watch others of our videos in our previous analysis. Other names exhibit higher ratios like this. I'm thinking of Tesla, for example, that released last week. But overall, seems to be a good setup. But as you know, playing it depends on your risk tolerance. So don't necessarily go into very wide strangles or straddles. Perhaps compose a position with a risk reward that you are comfortable with. Now, while we're on Microsoft earnings, let's take a second to dive into an interesting aspect of playing earnings, where we can actually play earnings earnings as you imagine by playing a group of stocks or other stocks that sort of resemble and move together with the stock we're interested in. This is what we call sympathy plays or proxy plays, where rather than playing the stock reporting, so here in our case we're looking at Microsoft, well, basically the section does the math where we do look at, okay, what other stocks actually move on that same day, and here we're talking on the day of earnings of Microsoft, and we're able to compose this correlation score of basically these stocks being moving together on one's earnings dates. And so as you notice, for Microsoft, the top names sort of make sense, where the highest correlation we found was with CRM, with Salesforce, a correlation of around 67%. What does it mean? It means that usually when Microsoft moves a lot on its earnings days, well, CRM actually does the same on that same day. And so here we in this quick table we see some examples of those symmetrical moves. For example, in the last year in 2024, when there was a drop of 5.1% on the April 25 release for Microsoft, well, CRM dropped 2.4% that same day. The earnings before that, a 2.8% drop. Also, we saw a similar drop in CRM. So this is interesting to watch, where if you're not comfortable playing the IV crush and everything that comes with the earnings of that specific stock, you can basically mirror it, and so use names that historically have been showing a good correlation with that stock, but again, on their specific earnings date. So here, we're really not interested in CRM or Apple's or ENTC earnings. Well, I thank you for watching. Hope this was helpful. Don't hesitate if you have any questions or comments. Make sure to like and subscribe, and see you in the next video.